Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good. I'm ready to dive into this.
So I want you to imagine something for a second. Imagine you are driving down the highway at like 150 miles per hour.
Okay, pretty fast.
Yeah, extremely fast. But while you're driving this sports car, you're also wearing a heavy crash helmet, you have a parachute strapped to your back, and your left foot is just, hovering right over the brake pedal.
That is a very stressful way to drive.
Right. You clearly want the thrill of the speed, but you are absolutely terrified of the crash. And according to recent analysis, that is exactly what the United States stock market is doing right now.
It really is. It's a completely bizarre and contradictory environment out there. We have this situation where investors are simultaneously showing, extreme greed, but also extreme fear.
Which usually don't go together.
Exactly. Goldman Sachs actually published some really fascinating research on this just recently, as of mid-May 2026.
Oh, right, I saw that.
Yeah. And their analyst, Brian Garrett, he actually had to coin a brand new term just to describe what we're looking at. He calls it the upcrash.
The upcrash, it sounds like an oxymoron.
It does, yeah.
But it honestly captures the reality perfectly. Let's look at the actual numbers to set the scene for you listening. Over the last couple of weeks, and we're looking at data right up through May 14th, 2026 here, the market has just been on an absolute tear.
A historic tear, really.
Yeah. The S&P 500 and the NASDAQ are hitting record highs. We just saw the S&P gain 0.8% and the NASDAQ gain 0.9% in a single day.
Which is huge.
And the Dow Jones finally crossed that massive psychological barrier, hitting the 50,000 mark for the first time since mid-February, I think.
Right, exactly. So if you just check your standard 401k balance today, you probably feel pretty great.
Oh, yeah, you're feeling like a genius.
And the catalyst driving those numbers upward isn't exactly a mystery. It's heavily fueled by optimism around AI and semiconductor chips.
Right, the AI boom is still going strong.
Very strong. We are seeing companies like Cisco surging 13.4% recently on the back of really strong earnings, and this seemingly just bottomless demand for AI infrastructure.
So the surface level story is just pure economic optimism. People are making money.
Right, but the underlying data tells a totally different story.
Okay, let's get into that because this is where it gets weird.
It does get weird. So in a standard stock market rally, when prices go up and everyone is making money, the market's fear gauge, which is a metric called the VIX, normally drops.
Because people relax, right?
Exactly. They look at their rising portfolio, they feel richer, and they kind of let their guard down. But right now, the spot price on the VIX is hovering stubbornly around 17.26 or 17.87 at close.
Wow.
Yeah, which is completely abnormal for a market that is busy breaking all-time high records left and right.
Just to give you listening some context, a VIX of 17 or 18 is, it's definitely lower than the high 20s we saw back during the geopolitical shocks in March.
Right, the interest rate shocks and all that.
Yeah. But an 18 on the VIX still means investors are paying a huge premium for downside protection. They are buying the stock, but they refuse to let go of their expensive insurance policies.
Which brings us right back to your sports car with the parachute analogy.
Exactly. They're paying for the gas to go fast, but paying a premium for the parachute. So how does this engine actually work? Because it's not just people randomly deciding to be greedy and scared at the same time, right?
No, not at all. There is a mechanical structure forcing this upcrash to happen. And it really starts with the massive valuations of these tech companies.
Like NVIDIA and Micron.
Yeah, let's look at the heavyweights. NVIDIA is currently trading at $235.74, which gives it a staggering $5.7 trillion market cap.
Trillion. With a T.
With a T. And Micron is sitting at $776.01, mainly driven by a severe shortage in memory chips.
So investors obviously want a piece of that growth.
Of course they do. But they aren't just logging into their brokerage accounts and buying shares of the stock outright. That's the key. They are heavily relying on the options market. Specifically, they're buying call options.
Okay, let's break that down for the beginner investor. Because if you buy a regular share of NVIDIA, you own a tiny slice of the company. But a call option is a totally different
It
beast.
is. It's essentially a side bet.
Right. When you buy a call option, you're paying a small upfront fee to reserve the right to buy that stock at a specific price by a specific date.
Yeah. Think of it kind of like putting a house on layaway.
Oh, that's a good way to put it.
Right. You pay a non-refundable deposit to lock in today's price. If the neighborhood suddenly becomes the hottest real estate market in the country and the house value doubles, well, you still get to buy it at that original locked-in price.
So your small deposit translates into massive profit.
Yeah.
Exactly. Massive leverage. But if the house loses value, you just walk away and you only lose your deposit.
So all these investors, both retail traders at home and these massive Wall Street hedge funds, they're just buying these call options hand over fist. They're placing aggressive short-term bets that NVIDIA and Micron are going to keep skyrocketing.
They are. But here is the catch. Every time someone buys an option, someone else has to sell it to them.
Right, there has to be a counterparty.
And the entities selling these options aren't everyday people. They are massive financial institutions known as market makers.
The market makers, they operate very differently than regular traders.
Very differently. A market maker does not want to gamble. They function much more like a casino operator.
Okay, so how does that work?
Well, a casino doesn't really care if the roulette ball lands on red or black, right? They just want to collect the table fee and eliminate their own risk.
Right. So if a market maker sells you a massive call option betting that NVIDIA will go up, they're suddenly exposed. If you win that bet, the market maker has to pay you out, which means they could potentially lose billions.
So to stay neutral, they have to protect themselves. They need a hedge.
Exactly. So what do? They turn around and buy the actual shares of NVIDIA in the open market.
Oh, I see.
That way, if the stock goes up and they owe you money on your option, they also made money on the physical stock they just bought.
Yeah.
It balances out to zero, and they just keep the little fee you paid them.
Wait, so is the tail wagging the dog here? Are these side bets actually forcing the main stock prices to go up in a sort of self-fulfilling prophecy?
Yes, that is exactly what's happening. That mechanism right there is the hidden engine of the 2026 market. As thousands of investors buy a frenzy of call options, these massive market makers are mechanically forced to go out and buy the underlying stock to protect themselves.
So the market becomes kind of this blind machine. The buying of the options forces the buying of the stock. That pushes the stock price higher, which makes the options more valuable, which forces the market makers to buy even more stock.
And that self-fulfilling loop is what Wall Street calls a gamma squeeze.
A gamma squeeze.
Yeah. And I mean, I wouldn't say the fundamentals of these AI companies don't matter at all. Their earnings are still historically massive, which is what started the fire in the first place.
Sure.
But you are absolutely right that in the short term, the plumbing of the options market is just pouring gasoline on it. This mechanical forced buying is what is creating the upcrash.
Okay, so that perfectly explains the massive automated buying pushing the market up. But it brings me back to the parachute. Why is everyone still clinging to their expensive insurance? If the machine is programmed to just keep buying, why is the VIX still hovering at 18?
Because underneath all that automated buying, human anxieties are still very, very real. Market participants haven't forgotten the broader context.
Like the geopolitical risks from March?
Exactly. And energy prices are still a persistent headache. The Federal Reserve's path on interest rates is, frankly, still pretty ambiguous. But to really grasp why investors are so terrified of dropping their insurance, we have to look back at the ghost of 2025.
The April 2025 event.
Yes.
According to historical data, this was a massive turning point in how investors view safety. Because on April 9th, 2025, President Trump announced a delay on certain tariffs.
Right. It was a significant shift in trade policy.
And the market's reaction to that specific policy news was just breathtakingly violent.
It really was. In a single trading session, the VIX plummeted by roughly 36%.
36% in one day.
Yeah. That remains its largest single-day percentage drop ever recorded.
Let's pause on that because a 36% drop in a single day is tectonic. If you're an investor who bought products tied to volatility, maybe trying to hedge your portfolio, a sudden drop like that completely breaks your strategy.
It shatters it. The sudden collapse in the VIX caused absolute chaos for any ETF or financial product linked to market volatility. Investors learned a very painful, very expensive lesson that day.
That volatility isn't just a slow-moving wave you can ride.
No, it can act like a trapdoor. They realized that a single policy announcement out of Washington can completely upend the pricing of these complex financial instruments in a matter of hours.
So investors are basically carrying the trauma of that 2025 trapdoor with them today.
Exactly.
So the VIX isn't just a simple fear gauge anymore. It's telling us that the cost of chasing the rally through those call options and the cost of buying insurance are both getting incredibly expensive at the exact same time.
Right. People are throwing money at the AI casino, but they remember 2025 so vividly that they refuse to leave the building without an expensive bulletproof vest.
And that simultaneous two-sided demand creates an immense amount of friction in the system. The market is fundamentally fighting itself.
It is.
But if both sides of this market are aggressively pouring money in one side, hoarding tech options to force the market up, the other hoarding insurance because they expect a sudden drop, that creates a highly pressurized environment.
Very highly pressurized.
And historically, when a market gets this wound up, something inevitably breaks. Are we staring down the barrel of a second Volmageddon?
Well, it is a comparison that many analysts are drawing right now.
Oh.
And for those who aren't familiar, the original Volmageddon occurred back in February 2018.
I remember that.
Yeah. Leading up to that event, the market had been incredibly calm for a very long time. Investors grew complacent, and they started pouring billions of dollars into complex products that essentially placed a bet that the market would stay calm forever.
Right. One of the most infamous products from that era was something called the Fourth Thief. It was an ETN.
Yes.
And an ETN is basically just an IOU from a major bank. In this case, the bank was saying, if the stock market remains boring and calm, we will pay you a steady return.
And everyday investors treated it like a high-yield savings account.
Until the market stopped being boring.
Exactly. In early February 2018, market volatility suddenly spiked. And because of the mathematical way that Orphe ETN was constructed, that sudden spike didn't just cause the product to lose a little bit of money.
Right.
It triggered a catastrophic collapse. The Orphe wiped out nearly 90% of its value in a single day.
Unbelievable. Imagine logging into your retirement account. You put $50,000 in on Monday, feeling like a genius because it's been making steady money for months, and by Tuesday afternoon, you have $5,000 left.
It vaporized billions of dollars of wealth overnight.
So the fear today is that our current upcrash market is building toward a similar breaking point.
There is a critical distinction, though, between 2018 and today. In 2018, everyone was crowded onto one side of the boat. Almost the entire market was betting that volatility would stay low.
Okay, so it was lopsided.
Exactly. Today, we have a two-sided overheating. We have massive call option buying forcing stocks up, but we also have massive VIX buying preparing for the downside.
Yeah.
Because the positioning is split, an exact replica of Volmageddon isn't necessarily imminent.
But the structural vulnerability is still there. I mean, the danger of this upcrash is that the exact same mechanical engine pushing stocks to the moon can throw it in reverse.
Yes.
If the market makers are forced to buy stock when options go up, they must be forced to sell it when options go down.
And that is the fragile underbelly of this entire system. Let's say a piece of bad news hits. Perhaps a major AI company misses its earnings target, or there's an unexpected geopolitical escalation.
Right, the momentum stalls.
The momentum stalls.
Yeah.
The call options that people were buying begin to expire or lose value. Suddenly, the market makers who bought all those millions of shares of NVIDIA and Micron to stay neutral, they don't need that protection anymore.
So they dump the shares.
Exactly. They offload billions of dollars of stock into the open market all at once because they no longer need the hedge.
And that aggressive mechanical selling drives the stock price down,
Which makes other options lose value.
which forces more market makers to sell more stock.
Right. The gamma squeeze flips from a virtuous cycle into a vicious downward cascade. Because there is so much leverage built into the system right now, the selling triggers more selling.
It's like building a 100-story skyscraper, but instead of anchoring it in bedrock, you build the foundation out of massive industrial springs.
I love that analogy.
Yeah, I mean, those springs might help bounce the building up into the clouds a lot faster when the wind is blowing right. But the moment the wind shifts direction, that entire building is going to bounce and whip violently downward.
Because the structure amplifies the movement in both directions. That is the perfect way to understand systemic fragility. On the surface, crossing 50,000 on the Dow looked like an unshakable concrete foundation. But underneath, it's resting on the tightly coiled springs of the options market.
So we've spent this time diagnosing a very weird paradoxical condition in the financial system, but diagnosis is really only half the battle. The real question is, what does the everyday listener do with their 401k or their brokerage account right now? Because if the market is rocketing upward, You don't want your money sitting under a mattress losing to inflation.
Right.
But if it's built on springs, you don't want to be at the top floor when the wind shifts.
Navigating an upcrash requires a playbook that respects the momentum, but builds in extreme resilience.
Okay, let's hear the playbook.
First, we have to look at the short-term data. Over the next 1 to 3 months, the upward momentum is undeniably powerful. The data shows a highly unusual positive correlation right now between the NASDAQ 100 and one-month call options.
How unusual.
Over the last decade, we have only seen this specific pattern 4 times.
Wow. And historically, when this rare pattern flashes, what happens next?
Historically, it leads to a 2.7% gain in the market the very next month.
Oh, wow.
Yeah, that is significantly higher than a normal monthly return. Looking slightly further out, analysts at Goldman Sachs have set a target for the S&P 500 to hit 7,600 by the end of 2026.
So there's real strength there.
The underlying AI earnings are genuinely strong, and the mechanical buying from the options market is a very real force. You cannot stubbornly short this market or pull all your money out, or you will get run over by the momentum.
So the momentum is real, but looking at the analysis, it also reveals how dangerously narrow this rally is. When we talk about the S&P 500 breaking all-time records, it paints a picture of the entire American economy booming.
Right, but that's an illusion.
Yeah, in reality, this market is being forcefully dragged upward by just a small handful of AI and tech giants.
Yeah.
Cisco, NVIDIA, Micron.
Exactly.
If this is going to be a sustainable market, the rally has to broaden out. We need to see other sectors like healthcare, industrials, financials, and small-cap companies start pulling their weight. If the entire market rests on the shoulders of semiconductor chips, it is deeply vulnerable.
And that narrowness dictates how you should position yourself. The absolute worst thing you can do right now is try to outsmart the Wall Street algorithms by using leverage.
So no borrowing money to buy options.
Do not do it. This is not the time to take out a personal loan to buy short-term call options on tech stocks. The premiums, the entry fee to place that bet, are already priced for extreme movement.
Right.
Even if you guess the direction right, you might still lose money because you overpaid for the ticket.
What about the other side of the trade? If everyone is paying up for insurance, should the beginner investor try to buy products tied to the VIX to protect themselves from a crash?
No, you have to be incredibly careful with volatility products, specifically long-term VIX ETFs,
Why is that?
because you cannot go out and buy a physical barrel of volatility, right?
Right, it's not oil.
Exactly.
Yeah.
So these funds have to use futures contracts. They are basically agreeing to buy volatility at a certain price next month, but those contracts expire.
Right. It's like buying a car insurance policy, but the catch is you have to tear up your policy every single month and buy a brand new one.
Exactly. And if the market is currently fearful, the insurance company knows this, so the new policy costs slightly more than the old one.
So you're just constantly bleeding money.
Yes. That mechanism is called contango, and the penalty you pay every month is called roll yield. It is a slow, invisible bleed on your money.
So don't just sit on it.
Right. If you try to buy a VIX ETF and just hold it in your portfolio for a year waiting for a crash, the mathematical cost of rolling those contracts over will literally eat your investment alive.
Ouch.
Yeah. Those products are strictly for short-term, surgical hedging by professionals. They are terrible buy-and-hold investments.
Because the market is being driven by algorithmic forced buying, your defense shouldn't be based on complex timing or buying exotic insurance. It should be based on asset class separation, which actually brings up a massive hidden danger in the data that most people miss.
Oh, the hidden AI exposure.
Yes, hidden AI exposure in your standard retirement funds.
This is perhaps the most actionable insight for the beginner investor. You might look at your portfolio and feel very secure because you just own a basic, plain vanilla S&P 500 index fund.
Right. You think you are buying 500 equal slices of the American economy.
But the S&P 500 is weighted by market capitalization. The bigger the company, the larger slice of the pie they take up.
And because these tech giants have grown into multi-trillion-dollar behemoths, your diversified fund is actually extremely lopsided.
Very lopsided. A massive chunk of every dollar you invest is going directly into just 5 or 6 technology companies.
So you might have way more exposure to this specific AI options machine than you ever intended.
That is why the strategy for an upcrash is to respect the rally but lower your pursuit.
Mm.
Hold on to quality companies that have actual strong cash flows, but use this moment to review what diversified actually means in your portfolio.
So rebalance.
Exactly. If your tech positions have grown completely out of proportion due to this rally, trim them back.
You want to secure assets that are completely disconnected from the options market. Things like short-term treasury bills, cash, or even precious metals like gold.
Right.
Because if the wind shifts and the mechanical selling kicks in, anything tied to the S&P 500 is going to drop together. You need a buffer of boring, disconnected assets so that you aren't forced to panic sell when the skyscraper starts bouncing.
Exactly. It's about recognizing that the rules of the game right now are being dictated by market mechanics, not just company earnings. Position yourself so that you survive when the mechanics inevitably shift.
So, to summarize all of this for you, the upcrash is not a doomsday signal that the financial system is collapsing tomorrow. Rather, it is a giant, flashing yellow light on the dashboard.
Well said.
It tells us that the record highs we are seeing are built on a highly pressurized, fragile combination of forced mechanical buying and deep psychological anxiety. It is a market where you can absolutely still make money, but the ground beneath your feet is fundamentally unstable.
In understanding that instability is your greatest advantage, you don't have to predict the crash to protect yourself from it. You just have to make sure your foundation isn't built on the same springs as the rest of the market.
Which leaves us with a final, provocative thought to mull over. Right now, this entire mechanical loop, the massive options buying, the forced stock purchases, the sky-high insurance premiums, is entirely dependent on the explosive hype surrounding artificial intelligence.
Right.
But what happens 2, 3, or 5 years from now when the underlying technology of these AI companies just becomes normal, everyday, boring tech? When the massive hype inevitably cools off, will this multi-trillion-dollar options machine quietly close up shop? Or will Wall Street have to invent an entirely new narrative just to keep the forced buying engine running?
That is the defining question for the next decade of finance.
Don't forget to subscribe and hit that like button.